Today, I'll be going over FHA versus conventional loans in 2023. Which loan will save you more money? In this video, I'll be covering the basics of FHA loans and conventional loans, the different interest rates and closing costs, down payment differences, mortgage insurance differences, credit score, and loan qualification differences, the loan limits of FHA loans and loan limits of conventional loans, and I will compare two specific scenarios of using an FHA loan or conventional loan. And last but not least, how to get started. First, we're going to talk about the FHA loan and some basics. So first and foremost, the FHA loan is one of the easiest loans to qualify. It typically has a lower interest rate than conventional loans. Typically, it's a great option for those who have lower or medium credit scores. Keep in mind, if you have a credit score of 580 or above, you are able to put just 3.5% down. If you have a credit score of 500, then you will need to put at least 10% down. Keep in mind, an FHA loan is government backed. Keep in mind, a common misconception about FHA loans is that it is only for first-time buyers. That is not true. Last but not least, FHA loans have an upfront mortgage insurance premium of 1.75% of the loan amount. We'll go into details of that a little bit later in this video. Next, we'll talk about conventional loans. So some of the basics regarding conventional loans, you'll need a 620 credit score. Typically, your interest rate will be higher on a conventional loan versus an FHA loan. That is because an FHA loan is government backed and a conventional loan is not. For first-time home buyers, conventional loans allow for a minimum down payment of 3%, but many times we do recommend going with a 5% down payment. We'll cover why we recommend that a little bit later in this video. If you put less than 20% down, you will have a monthly mortgage insurance expense. Like the FHA loan, conventional loans are not limited to first-time buyers. Keep in mind, if you are considering purchasing a condo, many times conventional loans have a price adjustment, meaning the interest rate or the cost for a specific interest rate will be higher on a condo purchase. Now, let's go over interest rates and closing costs from a high level. Keep in mind, I am not quoting a specific interest rate. The rates I have shown here are just from the internet as of today. So on a 30-year conventional loan that's a fixed rate, you're looking at an average of 7.3% as of September 2023. The average FHA rate for a 30-year fixed loan is 6.79%. Now, one of the major differences between conventional loans and FHA loans is that upfront mortgage insurance premium. So with an FHA loan, you're going to have 1.75% of your loan amount as a upfront closing cost. Most of the time, this 1.75% is financed. So you can put that mortgage insurance premium added to your loan balance. In terms of closing costs for FHA loans, you're allowed to ask the seller to contribute up to 6% of the lower amount of the purchase price or the appraised value. For conventional loans, if you're putting less than 10% down, the max you can ask the seller to contribute towards your closing costs is 3%. Now that 3% goes up to 6% if you are putting down between 10 and 25% of your down payment. And if you put down 25% or more, you can ask the seller to contribute up to 9% of the purchase price or the appraised value, whichever one is lower. Now, from a high level, I'm going to cover some closing costs. Overall, an FHA loan and conventional loan will have very similar closing costs. From a lender fees perspective, there could be origination, underwriting, discount points to buy down your interest rate, appraisal fee. You'll also see title and escrow fees. The county will charge recording fees, potentially transfer taxes, and potentially HOA fees if the property has an HOA. For both FHA and conventional, if you have an impound or escrow account, that means you will have prepaid insurance, property tax, and interest. For conventional loans, depending on your down payment size and the state that you're in, you could choose to not have an impound or escrow account, which would reduce your prepaid closing costs. The major difference, as I've already mentioned, is that upfront mortgage insurance premium of 1.75% of the loan amount. That is with all FHA loans. Conventional loans will not have that. Now, everyone's favorite topic, mortgage insurance. What is mortgage insurance? It's basically the lender getting an insurance policy to ensure that they will be able to receive repayment even if the borrower defaults on the loan. For conventional loans, when the down payment is less than 20%, there is a monthly mortgage insurance. That amount will depend on certain variables such as credit, loan to value, number of borrowers, and debt to income ratio. For FHA loans, the monthly mortgage insurance expense is set and determined by the rates shown here, 0.55 of the purchase price, or it will be 0.75% of the purchase price, depending on if your FHA loan is a high limit loan. Now, for FHA loans, there is two ways to get rid of mortgage insurance. The first is if you put 10% down when you purchase, the mortgage insurance falls off automatically after 11 years. The second way is to refinance out of your FHA loan into a conventional loan. Otherwise, you will have that monthly mortgage insurance for the life of your FHA loan. Now we're going to talk about credit score and qualification. So the minimum credit score on an FHA loan could be as low as 500. That is if you are able to put 10% down. Otherwise, the minimum credit score to put 3.5% down is a 580. And in terms of front end debt to income ratio on an FHA loan, we're looking at 46.99%. As for back end debt to income ratio, we're looking at 56.99%. For conventional loans, the minimum credit score is typically 620. And for both front end and back end debt to income ratio, you're looking at a max of 50%. You might be wondering, what is debt to income ratio? I'm going to be covering that on the next slide. So, very common term that people are curious about, debt to income ratio. What is debt to income ratio, or better known as DTI? DTI factors in how much of your income goes towards paying off debt, and it's given as a percentage. So we're going to take a look at your gross monthly income, and that will be the bottom part of the fraction. Now, the top part of the fraction in the front end calculation looks at your monthly housing expense, which would include your principal and interest, your property tax, your homeowner's insurance, your mortgage insurance, if you have any, and your homeowners association HOA fees if you're in an HOA. Now, your back end ratio takes into your front end ratio, that monthly housing expense, and then it adds your other monthly expenses. Could be credit card payments, it could be child support, could be a student loan, personal loan. It could also be government ordered debt, such as, IRS payments. And if you have any other types of properties or mortgages, those would be included as well. On the next slide, we're actually going to go through a numerical example. Okay, so debt to income, or DTI, can sometimes be hard to just explain. So here I have some numbers and values in front of you to help better illustrate. So these borrowers have a total monthly income of $14,117.40. Their qualifying housing payment, or monthly housing expense, will be $5,413.13. So here we look at the front end ratio right? We put that monthly housing expense and we divide it over the gross monthly income, and we get 38.34%. For both FHA and conventional, this qualifies. No problem. Back end, we're looking at their additional other monthly expenses, probably a car payment, minimum credit card payments, student loans, and we take that total number and it's $6,266.13 over the gross monthly income, 44.39%. So once again, for both FHA and conventional, this would qualify. No questions asked. Just a quick reminder for FHA, that front end ratio can go up to 46.99 and back end 56.99. On conventional, the max is 50% for both. Now that we've gone over debt to income ratio, we're going to cover loan limits. And so the loan limit is the maximum allowed loan amount, and that will vary by county. And so typically, depending on the county and the median income of that county, you will have different loan limit amounts. So I'm just going to go over 6 different cities that a lot of my clients purchase in. First is Los Angeles County. So it is a high income area. And for both the FHA loan limit and the conventional loan limit, you're looking at $1,089,300. So that means that is the max allowed loan amount a borrower can get on an FHA loan and conventional. Orange County, same thing. High income area, high loan limits for both FHA and conventional. Same as LA. Now in Riverside County, we see a difference between FHA loan limit and conventional loan limit for 2023. Riverside, we're looking at a FHA of $644, and for a conventional, we're looking at $726,200. San Bernardino, similar in income, so same loan limits. Now, going into Northern California, we're looking at Sacramento, which has the same for FHA and conventional loan limits, $763,300, and also in Northern California, Santa Clara County, another high income area. So for both FHA and conventional, you're looking at a max loan limit of $1,089,300. Something to note about these loan limits is that they are updated every year. Okay, now that we've covered loan limits, we're going to go over a scenario comparison. So starting with the county, we're looking in San Diego. The property type is a condo. The purchase price is $676. The credit score is 732. So I'm going to start with the FHA scenario. In this specific scenario, we're going with a down payment of 3.5% and an estimated cash to close of $38,000 and an interest rate of 6.75%, which gives us a monthly payment of $5,771. Keep in mind, with FHA loans, the condominium community does need to be approved. If it is not approved or FHA approved, which can be looked up on the HUD website, there is something called a single unit spot approval, which is a process where they basically take the condition of that single unit and they verify that it meets FHA guidelines and requirements. So in the FHA scenario, we are looking at a monthly principal and interest of $4,305.10. In this specific example, we just used an estimate for this homeowner's insurance of $75 a month. This will be the same for both FHA and conventional. Likewise, for property tax, we used an estimate of 1.21% for both FHA and conventional. Those would be the same. The mortgage insurance is set at 0.55 because it is not a high balance FHA loan. And then your HOA would be 412. That would be the same for FHA and conventional. And that's how we get to this $5,771.28. In the conventional scenario, we are going with a 5% down payment, which our estimated cash to close here is $47,000. The interest rate is 7.875. It's about 1.25 higher than FHA. Keep in mind, with conventional loan and condominiums, there are typically price adjustments making it more expensive for a specific interest rate or giving you a higher interest rate. And the monthly payment is $6,221.05. In this specific example, the principal and interest is about $350 more. As mentioned previously, your homeowner's insurance and property tax would be the same. And here, the mortgage insurance is actually about $100 more expensive than FHA as well, making the FHA payment about $500 cheaper a month. On the next slide, I'm going to be covering how we calculate the 0.74 for the conventional mortgage insurance. So, how to calculate mortgage insurance for conventional loans? The first thing that we're going to be looking at is the loan to value. This means loan to value is the loan amount compared to the appraised value. So we are going to be assuming in the last scenario, we did 5% down and we had a credit score of 732. So our base rate here is 0.66. And in that specific example, we actually had above 45% debt to income. So we would slide over using the credit here of 732, go down to our loan to value of 95% because we put 5% down, and we would add 0.14 to this 0.66. And then we had two borrowers in this scenario. Once again, we'd go from credit of 732, slide down, and we would actually subtract 0.09, and that's how we ended up with our 0.74 here. Now, going back to this chart, there will be a link in the description for this chart so you can actually calculate mortgage insurance yourself. Now that we've gone over how to calculate mortgage insurance for conventional loans, I'm going to go over another scenario comparing an FHA loan versus a conventional loan. So in this example, we're going to be covering a single family home in Riverside County with a purchase price of $515,000 and a credit score of 683. We'll start with the FHA scenario first. So we're looking at a down payment of 3.5%, which ends up with an estimated cash to close of $28,300. Keep in mind, this 3.5% down payment is included in the cash to close. We are also assuming a 6.25% interest rate, which totals for a monthly payment of $3,969.29. Now, this $3,969 is made up of the principal and interest here of $3,113.51. Homeowner's insurance and property tax will be the same for both FHA and conventional. In this specific example, we had insurance of $92.75 a month and a property tax of $536.46. Remember, for FHA loans, as long as it's not a high balance loan, we have this multiplier of 0.55%, which ends up in $226.57. In this conventional scenario, we are going with 5% down. So the cash to close does increase to about $47,000 with an interest rate of 7.25%, about 1% higher than the FHA rate, and a total monthly payment of $4,407.08. So highlighting the major differences here, the principal and interest amount, or your monthly mortgage payment, is about $220 more. Obviously, as mentioned before, homeowner's insurance and property tax would be the same. In this specific example, the mortgage insurance is almost double because of the credit score and loan to value. So the conventional payment is about $400 more a month. In this and the earlier example, the FHA loan has lower cash to close and lower monthly payments. Now that we've gone over two different scenarios of FHA versus conventional, if you're curious about which loan is better for your specific scenario and you're wondering how to get started, here are the next steps. Email our team over at loans, LOANS, at knowyourmortgages.com. After you email our team, we will review your specific scenario and we will come up with a game plan and compare which loan option is right for you. After our comparison, you can confidently go home shopping and get your offer accepted to open escrow. Once we get through escrow and that title or deed gets recorded in your name, move in to your new home. As always, from the Know Your Mortgage team, if you found value in this video, please share.